Welcome to Markets Now. I'm Michelle Rook along with Nick Tsiolis with Farmers Keeper. And we started off mixed this morning in grain and livestock futures. But now as we're moving through the early portion of this session, we're actually seeing some plus sides in a lot of things. And Nick, let's talk about the grain trade. First of all, we're getting into end of month, end of quarter, going into reports, and you've got funds pretty short in both corn and in the wheat market. So is what we're seeing today a little function of that or what?
Yeah, it could be. And also we've got a lot of farmers just holding off making any sales themselves right now, with futures overall having degraded and basis degrading as well. So we're seeing a lot of resistance from farmers with open bushels that they have, and also pairing that with what we may see when the combines are really rolling out there over the course of the next couple of weeks. And we're not just speculating about yields, is that I think we're going to find some extra bushels out there in some of the areas where we thought things were going to be a disaster. But that's going to add more supply in there that we're going to have to come up to meet. So hopefully this is the market trying to match up and incentivize the farmer a little bit to make sales, but there's not a lot of good reasons to right now.
Well, we should talk about the seasonals because we usually get harvest pressure, but you can also kind of start putting in a harvest low about this time, right?
Right. And so I think about that kind of like an uphill battle, right? Any bullish news that you get is going to work against those seasonal trends. And if we look back now to June, July timeframe, we also were following that more typical pattern seasonally than we've seen over the past few years of summer highs, right, being built into things. And now we're getting into a situation where if we do find some extra bushels in certain areas where we thought the crop would be a little bit shorter, that all plays into that same narrative that's more typical than what we've seen 2 or 3 out of the last 3 years, where prices started shooting up again because of exports at harvest. But there's no signs of that right now, especially with Brazil having record exports this month and booked for next month as well.
And not only that, but we have low water levels on the Mississippi again. And so that's playing into that too, isn't it?
Absolutely. We're getting text message pictures from our customers on both sides of the river around Memphis and certainly further down south as they're hauling in grain, just showing how bleak it looks out there. Then again, it's not like we've got so much export demand that it's going to make a huge difference. But if you look especially at soybean basis further and further south on the Mississippi, it's really fallen off a cliff. And now that futures have come down with that, it's kind of a double whammy effect out there. So producers are stuck in a situation of, I usually make these sales for cash flow towards the end of the year, and I'm used to storing corn. But on the other hand, I've got to get this off my hands. If I can wait, and I think basis is going to get better, that might be a good option there because things have really fallen off.
So because of what you just said here about, or earlier, about the fact that there are farmers that maybe are storing a little bit more corn, does that mean basis levels have been just a little bit stronger there?
Certainly in the center portion of the river around Mississippi, when we look week to week in our analytics or month to month, it's degraded quite a bit. But that also is not really the full story. It doesn't take a genius to know out there that basis has fallen. We're also seeing outside of those areas where processors are starting to pick that up and raise their basis. But what we're noticing in the numbers is because they know that demand has fallen and capacity has fallen so much at the river, they're not spiking their bids nearly as much as they're used to, which means we should see some pretty good, it could be a leading indicator that we'll see good margins coming out of those processors. And certainly that's the way that American agriculture is going to have to move with a shifting export market of where China is going to be buying and what Brazil is doing with their export programs, where we probably need to invest more here domestically for different uses with biodiesel and ethanol, of course, for our own grain. So we're not as dependent on those markets, because that's a big concern for me. It's really out of our control.
Absolutely. And, as you point out, South American competition has been really hurting both corn and beans, but also we've got that higher dollar, 10-month highs here now in the dollar index. And so that's another headwind, isn't it, on exports?
Absolutely. That's certainly not helping. And if you take it out towards geopolitics and macroeconomics, look at some of the deals we're doing right now, trying to shift more manufacturing capacity over to Vietnam from China. I hope we're not really starting too much to do this kind of decoupling effect there, but that affects us in global markets because as you and I both know, it's really a balance about how strong the dollar is versus how weak it is. It's really a seesaw effect. And so that's reflecting in what we're seeing in exports right now. And that's why the river levels have really dropped basis. It's kind of funny. We're in a similar situation to where we were a year ago, where river levels were low, but with an even worse export outlook.
Yeah, no doubt. We should also mention we do have reports coming up here on Friday, and sometimes that quarterly stocks can be kind of a market mover here. What are you expecting?
Yeah, so I always go with what the average analyst estimate is because I don't want to get caught on the wrong side of anything. We're not expecting many big changes to anything coming this week, but you're right. Historically, this report can be a big market mover, and it can be a leading indicator of what stocks overall are going to look like. Again, is that going to play into the narrative of, well, exports aren't looking great and logistically we've got issues going on, so we tank things down? I'm not sure. I always go back to what I say oftentimes. Consider as a producer what your own particular situation is, right? What percent sold are you on the board? How much basis have you committed? What does your cash flow look like if you do want to store and kind of get over that hump and wait for better prices that may or may not ever come? Let's be honest about that. Just because you're storing grain doesn't mean you're going to get better prices for it. Certainly those tend to be the seasonal trends, but you've got to factor that in with your own cash flow. So I'd rather be speculating on the on-farm situation versus what could or could not happen out there with global factors that we're not necessarily in control of on the farm.
Right. Technically, we've got November beans back above the 100-day moving average at least, but we've got December corn kind of running up into chart resistance that we need to take out, right?
Yeah, absolutely. I mean, as we see the spread between September and D start to change as well, and as we really shift over into next week with some of those deals that guys are getting for early corn, we've got to see some action coming here. Again, like you mentioned earlier, we are still walking into that early November time period that are the typical seasonal lows. So every bullish piece of information that you're hearing out there has got to go against that. When you pair that with what's going on with a strong dollar and the stock market taking some hits here, good point about end of the month, end of the quarter, that's going to be tough from a fund perspective for them to put some juice in this market at a time of the year where they typically don't already.
Absolutely. And to your point there, obviously that has impacted the cattle market negatively here this week. We did some technical damage, especially in the feeder cattle market yesterday, trying to bounce here. But I know you've been surprised that we've stayed as high as we have, as long as we have.
Yeah. Every time we see the chart turn red like that, I'm sitting there thinking, okay, are we finally going to retreat from these high prices that have been pretty well sustained over a good amount of time? And it just doesn't seem to come true. We took such a big hit that it might be a reversal there. But at some point, if trends continue the way they've been going, putting away the past week or so, the consumer at some point, as we get towards the holidays and spending surges, is going to have to retreat from prices theoretically if we kept going up. I'm not sure what that is in the American lifestyle creep that we have going on as we continue spending more on consumer goods. You just think at some point it's too expensive to get a steak. I can tell you right here across the street at the butcher shop in Chicago, it's $21.99 for a bone-in ribeye. That's really expensive.
Wow.
Crazy.
Yeah, no doubt. Well, we'll see if we can keep going here, especially since we've got pretty low unemployment. So hopefully we can keep this trend going. All right. Thanks for joining us, Nick Tsiolis with Farmers Keeper, and that is Markets Now.
Have a great day, Michelle.